What if the next time you cracked open a nice, smooth, refreshing Coke, Coca Cola themselves actually paid you to drink it? Most people spend their lives funding beverage giants, but today, we're flipping the script to make Coca Cola fund your entire life. We're going to reverse engineer the exact math needed to turn dividends into a perpetual cash machine that covers your bills without ever selling a single share. What would it actually take to live off Coca-Cola dividends? Not make a few bucks, not buy one share and pretend you're Warren Buffett. I mean enough Coca-Cola stock to cover the average American household's annual expenses. The number, just a fair warning, is going to be bigger than you think. But the math is pretty simple, and once you understand it, dividend investing starts to feel less like a buzzword to appease the YouTube algorithmic gods, and more like something you can use to fuel your financial freedom. Let's get this out of the way super quick. This video isn't a recommendation to buy Coca-Cola. It's a case study. Coca-Cola is useful because it's one of the most famous dividend stocks in the world, and has raised that dividend for decades. It also gives us a clean example of how a dividend income strategy can actually work. So let's build the income stream from the ground up. First, we need the expense target. According to the Bureau of Labor Statistics, the average annual expenditures for U.S. consumer units, that was a mouthful, in 2024 were $78,535. And to me, that's kind of crazy to think when they also report the median household income at $84,000, but that's a different video for a different time. So $78,000. That's the number we're going to try and cover. So the question is pretty simple. How many shares of Coca-Cola would you need to generate $78,000 per year in dividend income? Well, Coca-Cola's board approved a 2026 annualized dividend of $2.12 per share. That means each share of Coca-Cola is expected to pay $2.12 over a full year, assuming the dividend remains unchanged. So here's the math part of it. Annual expenses divided by annual dividend per share. So we have our $78,000 divided by the $2.12. That equals 37,044.8 shares. And let's just round that little guy up to a solid 37,045 shares. You know, for the extra fun money. At that $2.12 per share, all of those shares would generate about $78,535. Now, here's where the number gets serious. As of June 2026, Coca-Cola was trading around $81 per share. So 37,045 shares times $81 is going to equal roughly $3.01 million. That's the estimated portfolio value needed to cover the average annual expense number using Coca-Cola's current dividend. So, unless you have a free $3 million laying around, I do apologize for the quick smack of reality. But here's the part that makes dividend investing interesting. In Coca-Cola's case, the company approved its 64th consecutive annual dividend increase in 2026. That isn't normal. That means Coca-Cola has raised its dividend through recessions, inflation, market crashes, multiple generations of investors. Again, that doesn't guarantee increases in the future, but it does show a corporate habit. Management has treated the dividend as a major part of the company's identity, and investors, they notice that. But here's the catch. Actually, there's a few. First, dividends are not guaranteed. The company's board can raise, freeze, reduce, or completely eliminate a dividend whenever they want. Second, dividend income is usually taxable. So if you need $78,000 after taxes, you'd likely need more than that 37,045 shares. Third, the stock price is still going to move up and down. Even if the dividend keeps coming, your portfolio value can fall. So dividend investing doesn't remove risk, but it does change it slightly. Instead of asking, how much stock can I sell this year? You're asking, how reliable is this company's cash flow? And it forces you to think more like an owner. Now, let's compare this to the traditional 4% rule. The 4% rule says you withdraw 4% of your portfolio in the first year of retirement, then adjust that dollar amount for inflation in future years. Using the same $78,000 spending number, the 4% rule would require about $1.9 million in your account. And it doesn't take a CPA to understand that that's a lot less than $3.01 million needed from Coca-Cola dividend income. So at first glance, the 4% rule looks way more efficient. And obviously, mathematically, it is. But the mechanics are different. With the 4% rule, your income comes from the portfolio, from selling off portions of your collected assets for your lifestyle. While a dividend-focused strategy, the goal is different. The goal is to live off the cash flow without selling the underlying shares. You still own the asset sends you cash. And if the dividend grows, your income can rise without you selling more shares. Here's the cleanest way to think about it. The 4% rule is a withdrawal strategy. Dividend investing is an income strategy. The 4% rule asks, how much can I safely take out? And with dividend investing, you ask, how much income can my assets produce? But here's the reality check. If you're starting from zero, Coca Cola dividends alone are not going to replace your income quickly. At today's numbers, one share pays $2.12 per year. 10 shares, that goes up to about $21 per year. All the way up to 1,000 shares, your pay is going to be about $2,120 per year. The early years are painfully slow. That's why dividend investing usually works best with time, reinvestment, and consistency. You buy shares, the shares pay dividends, you reinvest the dividends, you buy more shares. And the cycle continues until the sun burns out or you become worm dust, whichever is going to come first. Dividend investing isn't about getting rich overnight. It's not going to happen. It's about converting capital into cash flow. And once you see the math, the strategy becomes a little bit clear. You're not just buying stock, you're buying a tiny piece of a business. And if that business keeps producing cash, keeps rewarding shareholders, and keeps raising the payout, that tiny piece can become part of a much larger income stream. That's the real power of dividend investing. It's not hype, it's certainly not going to be a shortcut, but it is going to be ownership, cash flow, and time.